Welcome, Patrick Camuso, to the Wholesome Crypto podcast. It's really exciting having you here today. And I've watched Camuso CPA grow as a firm. I know you've been in the industry for a long time, but I want to know more about you. So thank you for joining me today.
Absolutely. Thanks for having me on. I appreciate it.
Yeah. And one of my first questions is always, where were you when you first heard Bitcoin?
When I first heard Bitcoin, I was probably alone in my bedroom, honestly, reading a
Like
white
most of
paper
us.
like very, very late at night. And the way I came across it was I was in some forum reading about like gold and silver and the Federal Reserve and the money printing and all of that. And someone dropped the Bitcoin white paper in there. And that's how I came across it. And I was enthralled with it from the first time I read it. I think having that understanding of the financial system leading into it, and then having the accounting background, understanding the power of the triple entry accounting really allowed me to just, see it for the opportunity it was.
Yeah, it's pretty amazing. There's two different sides of the story when someone reads a Bitcoin white paper. They're either, this makes no sense, it's kind of silly, or they're completely enthralled and they just know this is going to make a big difference, a big
Yeah,
impact in the
definitely.
world. Yeah.
Definitely.
And as you were reading the white paper, it was making more sense to you. Is this where you felt like you'd start sharing it between friends and family? Did you
Yeah,
need to
friends
tell
and
people?
family. I was sharing it between like most people back then, and most people weren't that interested in it back then. I would say some were passively interested in it, and then a few were interested in it and got more involved. And yeah, so I did share it around, but not everyone is necessarily going to be like that deeply interested in it. I didn't really go much on the professional route, like trying to, because I was working in the Big Four at the time
Mhm.
when I was reading that. So I kind of kept it quiet on that side more. I wasn't really running around trying to like tell my colleagues about it, but friends and family definitely.
So were you a CPA at this point, or just?
Um, at this point, this was back in 2013. So no, I don't believe I was a CPA yet. I was working in the Big Four though as an accountant. But I would have gotten my CPA a few years after.
Gotcha. So as you were following the trajectory of Bitcoin and working, professionally to become a CPA on your own, what was that roadmap like for you? You were at one of the big fours working, reading about Bitcoin. You probably were going through some like internal dialogue of what to do with my life. What was going on in your head, and how were you going to take your life?
Yeah, well, I always knew I wanted to start my own firm from when I decided to major in accounting. Basically, like my goal was always like entrepreneurial bent, even though like, maybe most accountants when they're pursuing that degree aren't really thinking along those tracks, but that was really my goal. So I always wanted to launch my own firm. While I was at Deloitte, I was in the investment management group there. So we were doing the taxes and accounting for like hedge funds, private equity funds, mutual fund companies. So the long and short of that is we were dealing with large unstructured data sets of, thousands and millions of transactions that were securities, not crypto. That, we had to normalize, apply tax adjustments to, and deal with all of that data for tax and accounting purposes. So I was building like a good experience there as a financial accountant and tax expert. And yeah, I just started to basically, like, because I got invested into Bitcoin early, told some of my friends about it. I started to realize like, oh, there are going to be tax implications to this. Like it's early on, but people are not going to know what to do with the taxes. It's taxes property. I started to do like my own research into it at that time. So I just started to realize like, look, like I have a good experience level here. It may be early with this and somewhat risky, but I just think it's a good opportunity. And I took a big leap because back in 2016 there was not many crypto CPA firms at all, and crypto in general and Bitcoin wasn't really that big. I definitely took a big risk. In hindsight, it probably seems like a bigger risk than at the time. I was just like, this is, I think this is going to work out. I was pretty confident, but yeah, I took a big risk and saw the writing on the wall and believed that this industry was going to grow and that my firm would be able to grow with it. And that's exactly what happened. Because when I first started, I was mainly working just with um Bitcoin investors and Bitcoin mining companies. for the most part. And then, we've dealt with all the iterations that the industry's went through. Ethereum, then all the ICOs that came out, then the proliferation of all these blockchains. Then we had DeFi, NFTs, now Web3. All of those different proliferations, and even like every type of protocol and asset that hits the blockchain creates unique tax and accounting considerations. So I've been able to, get in early and deal with that learning curve through each step.
There was so much ambiguity, and well, still is ambiguity now, but but in 2017, I remember looking up, what do you do with your crypto investments? And I remember coming across your site, and you're giving a lot of educational content because that's what we just needed as an industry. There were so many questions unanswered. And at that time, everyone was just trying to do their best. That's all we could do, was just do our best and hope we have some type of guidance. But now there's so many like different tools to track your wallets, and so many different new regulations coming out for mining and staking, and then DeFi, and then your NFTs and this and that. And it's just getting a little crazy. So on a personal note, how do you even keep track? Like, what do you do to keep up to date?
Well, I would be very sympathetic if like a CPA is trying to walk into this space now and deal with the learning curve, because you're dealing with like, a 10-year history plus of like learning all the different formats and chains and protocols and everything like that. And then dealing with all the new stuff that's coming out just on an industry level. And then you got to deal with the regulatory side. So, there's not one place where you're just going to be able to like go and pop open like information that's going to just give you everything you need. You need to combine, like as a CPA, like I'm combining like having this professional level of experience and being able to, relate whatever's going on the industry side to the tax code and to accounting principles, and you bridge those two worlds together, because sometimes there's not going to be guidance on a new protocol or a new way of doing business that we're seeing on chain. So we're going to need to relate that to whatever, the available accounting principles and tax code are at that time, and take the best approach for our clients. So in terms of like how to stay up to date on everything, I don't think there's one particular spot. I'm deeply just like watching everything, and then always thinking about how does this impact things from a tax perspective? How does this impact things from an accounting perspective? And, I network a lot with other professionals that are starting to come into the space, and I think that helps as well. But you need to be very hungry for knowledge and just be taking it from all sources. You need to be understanding everything that's going on in the crypto industry, and then being able to relate that to taxes or accounting. So for everyone out there in crypto, I mean, they probably realize like there's not one spot you're going to be able to like just pop open your website and just get all your crypto information. It's you gotta work for it to a certain degree.
That makes sense. Yeah. And like you said, there's just too much information to find one source to tell it all, because it's just impossible.
Definitely. And I actually try to put out information myself to like to warrant other people too. And I think because of the approach that I'm taking, and like, this first principles approach to like seeing what's going on in the industry, and then wondering, how does that impact taxes or accounting, I'm able to identify some, emerging tax issues before many other people. An example of that recently is sales taxes, which to me, sales taxes feels like, crypto taxes back in 2016. They're basically like people that are transacting on chain, selling goods or services, artwork such as NFTs may have a sales tax exposure to it at the point of sale at the time of the transaction. That's a new one. The way I came across from that was just working with people selling NFTs and creating different marketplaces online, and starting to realize like there's going to be sales tax implications to those types of transactions. So there's always going to be new things that.
And you just speaking about all these different possibilities of getting taxed where you might not even know. How do you, I mean, a lot of your work, is technical and just math, but a lot of it, I'm sure, is emotional support. People come to you without any idea what they're doing and said, oh, I made these transactions. What's happening? How do you handle the emotional support of your business and your job?
Well, I try to be honest and transparent, and I think that goes a long way to people that are in bad tax scenarios. And it's something that I'm deeply familiar with because every single week, going back to how you were saying, like back in the early days, everyone was unsure what taxes and stuff like that. Still to this day, and this is a remnant of that issue. To this day, if you go on the IRS's website, they'll say there's a 75% non-compliance rate for taxpayers that have crypto. And they're basing that claim off of information they've collected via John Doe audits and other ways that they've acquired information from exchanges and other places. So the great majority of people are still not compliant. And, outside of just those types of statistics that we're seeing from the IRS, at my firm, every single week, we're still doing the accounting and the back taxes for people going back years and years. I would say on a weekly basis, we'll have to go back to the 2016 timeframe. Somebody probably it's less frequently, but it's still common that we'll go back and have to get someone from like the 14 to 15. So there's people that are coming to us every week that haven't filed their taxes or sometimes they haven't filed, or sometimes they filed and they've left the crypto off, but they haven't claimed their crypto and done their crypto accounting sometimes for the better part of a decade. So those are pretty painful engagements for those people because number one, they have all this angst with tax controversy. Sometimes they're getting tax notices from the IRS that are saying like, hey, we know you haven't claimed your crypto and you need to claim it. We see that a
Wow.
lot.
I didn't
So
know
yeah,
that.
people come to us, in pretty dire straits sometimes with a high level of stress related to these tax burdens. And it's not an easy process cleaning those up, as you could imagine. Like picture if you had to go back and do your accounting from 2016, there's going to be tons of data gaps, defunct exchanges, transactions you made that, there's, you sent it from this wallet to this wallet. Who did you send it to? Those types of questions. So it is a painful process, but like I said, being transparent, outlining the process from start to finish so they know which each step of it is, because it is also a long road to get this completed. So just being transparent and being honest about the options that are available to them, and really just trying to be a sounding board for clients and, hear their concerns and just really be the person that guides them through this process and gives them the full lay of the land so they know what to expect each step.
Yeah, and how you mentioned that 75% are non-compliant. With the current state of affairs of the political environment and what's going on with the IRS, do you are you excited? I mean, are you curious on how things are going to play out, if they will or will not get better?
Yeah, I mean, it's a double-sided coin because they're having less IRS agents, where that's what's expected. That may make it harder to like have as many agents doing audits, obviously, but there's been a lot of data collection. And what I've already seen in the past is that, you don't need an IRS agent to send out a tax notice to a crypto investor that hasn't claimed their trades in 5 years. So for this low hanging fruit of people that simply haven't claimed their transactions, it's easy enough to get that data and send a tax notice out to them, and most of that can be automated. And then you can get put in a position where with less staffing, there may not be it may not be as easy for those taxpayers to even reach out to the IRS and resolve that themselves. So there's that perspective on it. Uh, so yeah, I don't know. I think there's I think like the IRS, they're trying to wind it down, but the IRS itself doesn't want to get wound down, and they're gearing up for crypto tax enforcement for several different reasons. Obviously, the 75 non-compliance rate. Also, this year, the 1099 DA is coming out, which is a new tax form for cryptocurrency. So starting this year, you're going to start getting tax related to your crypto activity. This year, it's just going to report the proceeds, not the cost basis, but there's going to be even more reporting that's going out. So I understand like they're going to have less staffing, but there's going to be so much third-party reporting that's going out to taxpayers. And then that's going to trigger tax notices for a lot of people that aren't properly reporting. So I think a lot of people are going to have to deal with these issues, even though we're going to see things getting downsized, because not everything's going to be like an agent knocking at your door necessarily. Another interesting point outside of the information collection is it's been a couple months since I checked, so I don't know if they're in the next stage of this, but there were RFPs, requests for proposals, out on like government contracting websites to cryptocurrency software companies. And then those cryptocurrency software companies contract with subject matter experts, which are like crypto CPAs. And for audit purposes, that's who's going to basically be doing the calculations and then presenting those findings back to an IRS agent who then will conduct the audit. So, it's not like the IRS agent is necessarily going to have to be doing like the legwork on every single one of these audits either. So I think, those are two things to consider, is that there's just going to be like a lot of automated compliance for non-reporters. And then there's a lot of ways that the IRS can facilitate these audits, even with third party.
Should you go a little bit more into the 1099 DA and what that entails?
Yeah, so I mean, people are probably used to getting a 1099-B from their brokers. If you're trading securities on like Merrill Lynch or TD Ameritrade or whoever it may be, it's going to be similar to that. DA stands for digital assets, which is what the term the IRS uses to refer to cryptocurrencies and NFTs and other digital assets. So that information is going to start getting reported starting this year, the proceeds information, and then in subsequent years, the proceeds and the cost basis information. It's going to be a pretty big mess because of the decentralized nature with crypto. It's going to require deep reconciliations between their reporting and your reporting. And there's going to be data sharing that has to be done between you and the brokers if you're depositing assets onto their platform for which they don't have cost basis information. But basically, if you're transacting on someone that's defined as a broker, and we should get into that briefly as well, not too deep, but there's some big pieces to that.
Yeah.
But if you're defined as a broker, they're going to be putting in tax reporting. So if you go on Coinbase this year and transact, it used to be under a certain threshold, you wouldn't get tax reporting, but now it's much more likely that you're going to see that tax reporting. Now, the 1099 DA, this was something that was finalized last year. During the comment period for these new regulations, they wanted to include DEXs in that regulation. Meaning if you go to like Uniswap, you get KYC'd and all your tax information gets sent before you can even do a transaction.
Wow.
So there was huge pushback to that last year. But ultimately, the regs got finalized and included DEXs, believe it or not. So DEXs are included in that as of right now. So there's lawsuits going on regarding that with like different groups like the DeFi Education Fund, Texas Blockchain Council, others too. I can't think of them all. Blockchain Association, like they're all in a lawsuit together. There is a bill going through Congress right now to try to repeal the definition so it doesn't apply to DEXs, and that's getting pushed by Ted Cruz and others. So, people are still fighting back against it, but as it stands right now, DEXs in the future are going to be included in this definition. And what people are saying is that it's going to, potentially stifle innovation, number one, because it's a question of like, is someone like Uniswap going to comply with that, or are they just going to geogate out US people? And then the other thing too is that if they do that, there was statistics that came out on it, the amount of 1099s that would be produced as a result of that would be like more than all the 1099s that were produced last year for the whole entire like US. So
just all this data.
Look up those statistics yourself, but there was some stats that were thrown out on that. So it's going to be a huge undertaking from just from like a administrative standpoint for the IRS even to take in all this information. And then there's this whole issue where people want to maintain pseudonymity when they're transacting with their non-custodial wallets. So we'll have to see how it plays out. But right now, it's a huge issue, and it's something I think the industry is focused on a lot. But I think even more so, we need to be focused on that because it's going to be like huge imposition on people if they start to have this when they're transacting across DEXs.
It's amazing to see how much it's developed because, back in 2013, 17, a lot of the Bitcoin, and today, a lot of the Bitcoin ethos and crypto ethos is screw the government, screw the IRS. Like, no one pays taxes. Everyone Well, that's not no one pays taxes, but the whole tax money and where it's going to is also could be better tracked.
Yeah. And I don't
And
disagree with that. Look, I'm not
yeah,
happy about like, the opaqueness with all that and the fact that the tax dollars get wasted.
yep. And crypto can solve for that. We can decide where to put our tax money to rather than just giving it to a pool of unknown users. So it's kind of sad to see how much they're trying to go after people without really understanding what they are doing as our country as a whole. Because other countries are very open to it too. Like, oh yeah, Bitcoin's a legal tender or crypto is accepted and there's more clear guidelines to taxes. But in America, it's really confusing.
Yeah. And to even add to the complexity, so we had the 1099 DAs, and they're potentially applying to Texas, and then with those finalized regs, like right around the same time, they released this revenue procedure 2024-28. Along with that, a couple months later came out notice 2025-7, which is related to that. But the big one was revenue procedure 2024-28. What that did is it actually changed the way that cryptocurrency accounting has to be done for it. So in the past, everyone would do their accounting on what's called a universal basis. So what that means is like you would take all of your wallets and download all of the data from that, usually leveraging a crypto accounting software. So say you have like Ethereum across 10 different wallets. It would be under a universal method. It'll take your accounting method and it'll apply it on an asset by asset basis. Now what it's been changed to, and we'll talk about the timing of all this, what it's been changed to is what's called account-based reporting. So now you're not only going to apply an accounting method on an asset by asset basis, but on a wallet by wallet, exchange by exchange basis. So if you're holding Ethereum in 10 different places, it's going to apply an accounting method for each individual wallet rather than just lumping all the assets together. So in the past, people have been doing universal. That's what all the softwares basically did too, for the most part. So that change was required by December 31st, 2024. So anyone that's been on the universal before has to get their accounting updated through December 31st, 2024. And then there's actually a process to take your calculated basis that's done on the universal basis and then allocate it to where your actual holdings are. Now, what I see with this is that when most people come to my firm to do this, overall, like what I've seen even before this and what I've always stressed is like when people are doing their cryptocurrency accounting, they're not doing due diligence on it. They really pay attention to like, am I paying the lowest gain possible? And that's usually it. You know what I mean? But there's a very important part, and that is your ending basis. And I find it's almost like it's very common that it's inaccurate for people. And now it's a bigger problem for this revenue procedure because if you haven't done your accounting for years, or if the accounting has been done and it's inaccurate and your ending basis is wrong, you're saying you have 50 Ethereum and you really have 100 or vice versa, something's overstated or understated. Like you're going to have to get that all fixed and accurate before you can even do the allocations for the revenue procedure. And so the reason they did this revenue procedure is basically two reasons. Number one is with these 1099 DAs that are coming out, that's going to be reported on an account basis. So, they want to get the taxpayer accounting aligned with that third-party reporting. Number two, another thing that my firm has advised against, basically since our inception, is this abusive tax practice that the IRS has identified in this revenue procedure. And that was people using FIFO on a universal basis. So that's not going to fly anymore. And it's because of the account-based reporting and then also the standing orders, which I'll hit on in a second. But basically, like in the past, people would, under this universal basis where maybe you have Ethereum in 10 wallets, they would apply HIFO, highest in, first out cost basis. So you may be selling an Ethereum on Coinbase and your highest cost asset may be in one of your cold wallets, right? And it'll still apply the cost basis from that highest base asset in your cold wallet to that sale on Coinbase, even if you didn't transfer it to Coinbase. So it's basically claiming like an inaccurate audit trail if you do that. So people have been doing that for years, and the IRS has basically said like, no, that doesn't suffice for a specific identification. So now we have this revenue procedure that's stipulating not only account-based reporting, but now this other concept that's called standing orders, meaning that if you do not want to use FIFO, which is the default method for crypto accounting and always has been, despite popular opinion, you have to leave standing orders with your brokers and document them for your non-custodial wallets before the transactions take place. There's no more like you could go log into software and cherry pick the highest basis like 3 years later when you're finally filing your crypto taxes. If you put yourself in that position, you will be defaulted to FIFO in that case. So this revenue procedure is a big deal because number one, people have to just comply with it and do the transition. And we're talking here now, well past 12/31/2024. Most people I would expect haven't heard of it and they're probably late on it. So they need to get that up to date. And then number two, you need to get your accounting methodology straight. And then once you do these allocations, you need to be very strategic about your on-chain flow of funds and where you're holding your basis for any given asset and where you're spending it or transacting or exchanging with it.
It's so funny because this is why 75% are not compliant. You're changing the rules every year. It's not ever clear. And how do you expect people to be on top of it, especially individually? Taxes are so complicated before crypto. And now it's just a whole nother level of complexity. People want to do good. They want to try, but you have to give them the opportunity and leeway to give it their all. Otherwise, they're going to be in a big mess.
Yeah. And I do agree. I mean, that's why we see such a high non-compliance rate. But with the 1099 DAs and all these new rules that they're imposing, I think this is going to lead to them gearing up for tax enforcement. Because to me, the two lowest hanging fruits were always non-reporters and then people that were incorrectly applying these accounting methodologies on the universal basis. And now they basically, with the 1099 DA and the revenue procedure, they've taken the next step to address both, to where now they've given the safe harbor option for people to transition. And now they're having every transaction get reported to them. So now I'm expecting like the next hat to start dropping with tax enforcement because they're going to be able to go after more non-reporters and these people that have been doing the accounting incorrectly because of this revenue procedure, because of this safe harbor. They're not really going to have, if you're under an audit, it's going to be much harder to say, well, I wasn't sure, I didn't know, because now it's clearly outlined in that revenue procedure and they missed a safe harbor. So now, they'll be able to come down harder on them, I believe. And we've even seen from the IRS, like they've publicized, like expect more crypto tax enforcement to gear up, basically. And we've also seen like a landmark case last year with Richard Algren III, who was the first indictment from the Justice Department for a tax evasion case related to cryptocurrency. Richard Algren has pleaded guilty. He's, I believe, looking at 3 years in jail, and he also had to turn over his private keys to the Justice Department that holds approximately $120 million in crypto, reportedly. So there's going to be more cases like that, I believe. So, I think there's going to be more landmark cases like that. And then, like I said, like the other thing I'm seeing at a lower level is like thousands of tax notices go out to people just saying like, hey, we know you have crypto and you haven't reported it. And I deal with those all.
It's so scary to get that letter, I'm sure, just saying, we know what you have, better report it. Well, if you know what I have, then why are you even talking to me? Just do the taxes for me. It's like my big
Well,
pet
the thing
peeve.
is that you don't want them to do the tax for you for crypto, because I don't know how many, like if someone's out there and they're listening and they tried to do their crypto accounting, like if you just go and you just drop your wallets and your exchanges into whatever crypto software it is that's going to tell you, they can do it in 10 minutes, you'll quickly find that it's not going to be it. There's going to be data issues, and usually it's going to overstate your income or it's going to overstate your gain or loss. So, the burden of proof is on you as a taxpayer. So if you go under an audit, the IRS is going to come with a calculation that's probably not going to be favorable to you. And then the burden of proof is on you as a taxpayer. If they're saying your basis is 0 for this asset and you say it's $10,000, the burden of proof is on you. So it really becomes the burden gets put back on the taxpayer that if you wanna substantiate your basis for any asset, you have to have the audit trail for it. So it really just puts that burden on the taxpayer ultimately.
That's so harsh. It's just, even if you do report your taxes to the best of your ability and then the IRS comes at you saying, no, it wasn't good enough,
Yep.
it's just, and then burden's still on you. So it almost seems unjust, but
Yeah, I can't say that I'm a fan of it. That's just been the way that now in a criminal case it changes, but under a civil
yeah.
case, the burden of proof is on the taxpayer, and it's been like that since I think basically for as long as IRS has been around, unless I'm incorrect. So I don't really see that changing, but it puts taxpayers in such a bad position, especially if they haven't done their accounting in years, because there's almost always data gaps that we have. And that can lead to less favorable tax outcomes for those people. We try to exhaust every option regarding, documenting their basis. But if you have an asset and you just literally have no documentation on it at all, it's probably not going to be a good tax out.
I mean, thank you for educating us back in the day. I think your work has helped me file properly in the past. So I haven't gotten that letter, thankfully. But
That's
again,
good to hear.
I've
That's
been
good to hear.
filing as accurately as I can. And thankfully, I stayed away from crazy trades that, like meme coiners that do thousands of trades a day. And I'm just like, I'm just going to not deal with that. It's too much work.
Yeah, I think, we work with those types of people that, they have 20, 30, 40, 50, sometimes hundreds of wallets, thousands upon thousands of trades, sometimes millions of trades. Yeah, the complexity gets up there very quickly. And a lot of times these people are, taxes are an afterthought. So they're just kind of shocked that now they have to go through this whole painful experience. So that's another thing I would say is like always think about the taxes and accounting when you're transacting on chain, because the burden is on you to do it.
If I ever hear anyone saying, oh, I made X amount of money trading this coin, I'm like, great, put 30% aside and put it in your
Yeah,
bank
well,
and save it for
that's
taxes.
great advice, because every cycle I see people each cycle is different, right? But like this cycle it's meme coins, last cycle it's NFTs, like whatever it may be, like someone's going to make profit off of whatever the latest new emerging asset is, and then they're going to take that profit and they're going to put it back into whatever it is. Like this cycle Solana, maybe last cycle they're putting it back into Ethereum, right? And then inevitably we'll have a bear market come. Many times those bear markets like to come during tax seasons. So if you did that, you're still going to be paying the gains on that money you put into Solana. And then if Solana drops by 50% and you're planning to pay your taxes out of that asset, you've effectively doubled your tax bill, because now you have to liquidate double the Solana to pay for it. So that's a great point you make. I see tons of people that happens to them every single cycle where, they think the cycle's not going to end. They just keeping all of their profits on chain in a volatile asset, and they expose their tax payments to that validity.
It's painful to see because it's so exciting to make some money in this really difficult world, to just make money in general and be anything more than middle class. It's a good feeling for someone to like, oh, look what I made some money on a meme coin, but then they get destroyed in taxes
Yeah,
later and end up owing more money than they've made. It's just,
exactly. The IRS may make more money in crypto than anyone else once this is all said.
man. So let's get back into your entrepreneurial spirit. You are building this firm, you're building Camuso CPA. How was that jumping from, being on a big four and then going on to your own adventure? Is that a
I mean, they're
struggle?
completely different worlds. The big four is like, it's the big four. There's, it's the biggest accounting firms in the world. So it's, a very professional corporate environment. There I was working on very big clients, like, the BlackRocks and the Apollos and those types of clients. So it was great experience. And usually when you're in the big four, like a lot of the experience doesn't translate over. But luckily, because I was in this investment management space and dealing with all these transactions, like that part did translate over. But with, what I went in kind of inexperienced with is the whole side of running a business, pricing, marketing, sales, hiring employees, basically all of those things. I had to learn the hard way.
Yeah.
a lot of times. So yeah, I went into all that blind, and I had to basically put in a lot of effort and a lot of trial and error to overcome the gaps in my knowledge there, I would say.
Was there ever a point where you were like, this isn't worth it?
No, I mean, I could see why a lot of people would believe that, but I've just always wanted to start my own firm. So for me, it's kind of like do or die. There really is no other option. This is
Yeah.
like my life. So it's not like I'm just like, maybe I'll go back to work. It's like when I started my firm, I said, basically, this will be successful. I'll be living out of my car, basically. Like,
Spoken like a true entrepreneur. I love it. That's
yes.
good. Um, Now, what outlook do you have in like seeing these big companies like you're mentioning BlackRock and was it VanEck? I think they are also big companies who are, investing in crypto and putting money into crypto, and Fidelity is also doing the same. When people started hearing that institutional investors were coming in the game, that was really exciting. But also the other part of the coin is it's kind of dangerous having such big, large whales entering the market.
Yeah, I mean it's new. It's new market, especially for assets that they're going to be going after like Bitcoin. It's not just going to be person versus person any more trading against the market. Now we're going against institutions. So I think it's just the next evolution and maturity of the industry. At a certain stage, like 2016, 2017, we were all just hoping and wishing for these institutions to come and buy our bags, basically. So I'm happy to see it. And it's just the next level of maturity for this industry. So to a certain degree, it doesn't mean like certain opportunities are gone. Maybe with Bitcoin and other assets they may get into if you didn't front run them, maybe. But I think it's going to bring a lot more opportunities as well. Even when the institutions started getting in, I started to see like a lot more professionals and a lot more maturity come into the space overall. I think it's a good thing. I think it's the next evolution of Bitcoin as an asset class, and it's really starting to become an asset class now because it's getting the recognition of these institutions. So yeah, I mean, I don't trust these institutions. And I think you need to. Doesn't mean like they're just going to make the price go up forever or anything like that.
Yeah.
But I think overall, the adoption is great that we're seeing with them with Bitcoin, and eventually I think we'll see it extend to other assets as well. So I think overall, it's a good thing.
Yeah, that's the thing I always go through is like in my mind too is we want more people using crypto in general. Whoever just use it that way it gets more attention and more recognition. And it's when more people have it and get their feet wet into it, it becomes more of an interesting more of an interest for everyone to actually make it grow as a whole. And the whales, yeah, they control the price where they can just tank the price, buy a bunch more, bring it back up, sell it to all the
Yeah,
people. That's what they do best. The graph is hopefully going up,
exactly.
but it's also the other thing. It's like hard to, you know, again, the ethos, the original idea of it was to get off the US dollar or to get off fiat currency. So when people say, oh, make the price go up, it's, well, that's not the point, but it's supposed to take over the US
Yeah,
dollar.
but
But
also if you want to get off the fiat currency, like we need this adopted everywhere then too. So
yeah,
it's like I look at it that way. It's like this is if if it's going to trend towards adoption, like institutions are going to be involved in it, of course. And
mhm.
I think it's one step closer towards that. But yeah, everyone's still, of course, is still focused on the U.S. dollar prices, including the IRS.
It's hard not to. And so I guess one of my final questions I want to learn more about from you is, what is a moment in the crypto space, during your work or personal life where you had a wholesome moment in crypto?
A wholesome moment, I would say, probably in the early days, some of the first few actual clients, like outside of my friends and family, that took the jump with me, and became like one of my early clients at Camuso CPA. To me, that was wholesome just because it's just goes a long way, like in my journey as an entrepreneur and as a professional and as someone that was just founding his own CPA firm. So I still have a lot of those clients. They've stayed around for years, and I truly appreciate them. So that's probably the first thing that comes to mind.
That is a good feeling when someone believes and trusts and supports you. It's not
Especially in
easy.
something so new and intricate and different.
Well, thank you so much, Patrick, for joining me today. Where can people find you to look at what you do and what you can offer in services?
Yeah, definitely. I would encourage people, if you want to connect with me, you can go to my website at CamusoCPA.com. There's a contact form there. That's the best place if you want to, schedule a time to sit down and discuss your portfolio or your business one-on-one. I'm also on YouTube, on Twitter, on LinkedIn. You can just search my name, Patrick Camuso. Lastly, if you do go to my site, there's a resources page. And right now we have the ultimate crypto tax checklist for 2025. People can download that. It'll have great information. If you are self-preparing or you're working with a CPA and you want to make sure they're on the ball, they're not overlooking anything, that could be a good resource as well. So I would say check out CamusoCPA.com or check out, one of the social media platforms, and I'll be on there as well.
Again, thank you so much for sticking through this with us, the community crypto. Thank you for educating everyone on what's happening and, advocating where you can for the people and helping them through difficult situations that we're all in.
Definitely. Well, I appreciate you having me on. Thank you again very much.